So 3 accounts, the RSP I just talked about, the tax-free savings account, which is the TFSA, has been around for some time, since 2009. And then finally, the non-registered account. So what are the characteristics of those 3 accounts? So if we start with the RSP, it's an individual account. It's an account that is registered with CRA, and it's an account that has a maximum amount that you can contribute to over a given period of time. And the maximum annual contribution is determined by Canada Revenue Agency. It's also contributions made to the RSP will reduce your income taxes for the year. Another characteristics is the unused contribution. The good news, unused contribution room would carry over to the next year. So let's say that I have $10,000 worth of RSP room this year, and I don't make any contributions to my RSP account this year, then those $10,000 worth of contribution room would not be lost. It will actually carry over to 2023. The RSP account is also known as a tax deferred account. So what does that mean? Really, that means that no taxes are owed on any investment income, whether we talk about interest income or dividend income or realized capital gains. Another characteristics of the RSP account is the funds that you would withdraw are considered taxable income. So you can withdraw at any point in time, but if you do, then the funds would be added to your income for the year and therefore would be taxed at your marginal tax rate. Last but not least, one important actually feature of the RSP is that your RSP account must be converted to a RIF account, which is a registered retirement income fund, in the year that you turn 71. So let's say that I'm going to be 71 in November. That means that I have up to December 31st to have my RSP converted to a RIF account. So those are the broad characteristics of the RSP account. There are a few more, but I think that will provide the basic actually. The next account that I would like to talk about is the tax-free savings account, or TFSA. This is also an individual account that is registered with Canada Revenue Agency. Like the RSP, there is a maximum annual contribution room that is provided by CRA. Unused contributions, just like the RSP, can carry forward. Contributions made to the RSP, unlike what we had for the RSP, contributions made to the tax-free savings account are after-tax contributions. So you have to pay your taxes first, and then you can actually make the TFSA contributions. The TFSA is known also as a tax-exempt account, and this is one of the greatest, I would argue, characteristic of the TFSA, is that no taxes are owed on any investment income made within the TFSA account, whether we talk about interest, dividend, or capital gains. Amount can be withdrawn from a TFSA at any point in time. Those amounts would not be subject to taxes. However, if you wanted to recontribute the amount withdrawn back to the TFSA, you have to be extremely, extremely careful. And I will explain this actually. Let's say that I have invested in my TFSA account for many, many years, and I now have $50,000 in my TFSA account. Let's assume now that I am actually withdrawing $30,000 from my TFSA for, I don't know, let's say I need a car, I wanted actually to buy a car. Now, if I only have $10,000 worth of TFSA contribution room for 2022, and I just made that withdrawal, then I will not be able to contribute. Let's say that I no longer want to buy this car. and I change my mind and I want to put the money back into the TFSA, then I will not be able to recontribute the full amount of $30,000 because I only can contribute $10,000 in 2022. The good news is that if I wait for the next calendar year, for sure, the amount withdrawn will be added to my overall contribution room, and therefore at that point, I will be able to recontribute the entire amount. Something to be careful about, because any over contribution, there will be a penalty and there will be a tax applied to this, and it's quite actually substantial. So something to think about. Yeah. Now, the non-registered account is the third most commonly used type of accounts in Canada. I use the example of a cash account, which is an individual or a joint account, could be a joint account as well. There are no limits on contribution. Taxes are owed annually on any investment income. So whether we talk about interest, dividend, or realized capital gains, taxes will have to be paid on those gains made during the year. And there are no taxes on the funds that you would withdraw from a cash account. So pretty simple, but you see there are very distinct tax attributes between all three types of accounts.